but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low, under 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months, the spread backed off a bit, meaning gold lost some ground versus the S&P. And then when the recent reassertion of price back out above that 3,500 price level also drove the spread back up. Now, this spread reading you're looking at there was as of Friday.
Michael Oliver has been one of the most accurate analysts tracking gold, silver, and the broader equity markets for months. His technical momentum research, disregarded by mainstream media, suggests a rare structural realignment in precious metals. Oliver believes the silver-gold spread is reaching a turning point. His dual top occurs when silver has twice surpassed 1.31% of gold's value since 2022. A breakout beyond this level would complete a triple top formation, which he feels could initiate a persistent and dramatic acceleration in silver relative to gold. This ratio's momentum has broken above its long-term downtrend, indicating silver's fundamental strength ahead of its price, in his perspective. This analysis isn't standalone. A wider trend of global financial market stress and transformation. Gold is quietly outperforming the S&P 500 at one of its strongest levels in over a decade. However, few investors notice it. Oliver's research suggests that capital flows will migrate from stocks to gold as this relative performance pattern continues. He calls this the early stage of a long-term wealth reallocation as financial asset confidence erodes and investors seek physical value. Meanwhile, silver's chart shows something different. The metal has been consolidating for years, lagging gold post-pandemic. However, Oliver believes that underperformance has laid the groundwork for a significant breakout. Silver's move might be quick and violent if the spread verifies this breakout, according to momentum structure. If momentum leads price, the conclusion is obvious. Silver's next spike may happen faster than predicted, surprising investors. A macro reality underlies these technical patterns. Central banks still buy gold. Real rates are fluctuating near key levels, and inflation expectations are rising in numerous major nations. The US dollar's recent surge may nominally reduce precious metals. Oliver's work suggests that gold and silver are entering a phase of relative dominance. He bases his forecast on momentum, the fundamental signal behind market noise, rather than short-term price volatility. His charts indicate that signal is reaching confirmation. This video analyzes Michael Oliver's gold, silver, and miners' outlook. Why short-term volatility may be a sign of acceleration, and how relative performance charts show capital movement. Stay till the end if you follow precious metals or the next significant equity movement. Don't miss our next deep dive. Like, subscribe, and turn on notifications.
Protracted congestion, which is what we had April, May, June, July. In 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week, okay? But right now, we're not at that point. The action last week, to a large extent, put us in a position where, in our weekend report, we suggested that was probably mostly it, okay? Now, the only problem was gold hadn't taken out a prior week's low, and so we finally did. I mean, that means we got under 4,000. Okay, it's back above there now. Uh, I think the cleansing we just had is probably about exhausted. And that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so. Okay. And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. Uh, we're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those price, but also relative to the S&P. It kept coming down. And here we start in 2013. And in 2015, late in 2015, gold made its price low under, 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple of years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months, the spread backed off a bit, meaning gold lost some ground versus the S&P. And then when the recent reassertion of price back out above that 3,500 price level also drove the spread back up. Now, this spread reading you're looking at there was as of Friday. And it's probably backed off a little bit as of today. But at the end of this month is when we plot that final reading. Now, if you're at 60% or higher, and right now we were about 61 as of Friday, and there's gold divided into the S&P, 61% of the price. You're at one of the highest levels on gold versus the S&P going back 10 plus years. Meaning, in reality, gold is doing better than the S&P has for the last decade, but nobody notices that. But if you close credibly over that green line, which is now 1, 2, 3, 4-point trend structure, that is a massive relative performance breakout by gold versus S&P. Given the depth and the width of this base, and this is price versus price, so it's effectively a price chart, this has massive upside implications in terms of a shift in the money flows that go into gold and go out of the stock market. We're already seeing that. Gold's up a lot more than S&P over the last year, last 3 years even. So there's already been some money flow, but the average guy ain't in this market yet. And when this thing breaks out, we bet a couple things. One, gold's going to vastly outperform S&P going forward, probably for several years. It's going to be quite dynamic when it first comes out of here. It'll be like a whoosh effect. But you'll also start to get, probably a few months after this breakout, you'll start to get the headline type things that somewhat explain what is already happening. And we suspect those headline type things might be coming from the financial sector, where few people are looking. They're all looking at NVIDIA, okay? But anyway, forgetting the fundamentals, this tech to us, one, gold has been beating the S&P basically for the last 10 years because it's the highest level in that period. And two, it's breaking out, meaning this relative valuation says it's only just begun. It's not not late, it's beginning.
Understood. So when you see a basing structure like this and you see multiple attempts like it did in 2016, 2020, 2024, it backed off. So this is technically the fourth time and it's busting through at this point, although it's pulled back, like you said today, maybe retesting this resistance zone. How likely, what's the probability that when you see a structure like this, that it does break through ultimately?
Yeah. Now that's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure, not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right. Okay. But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going,
Okay.
okay.
Okay. So based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's
Yeah.
inevitable.
Yeah,
Okay.
and it will be soon because this thing is ripe as a beast. And we
Okay.
know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning.
Yeah. All right. So,
Okay.
Michael, the miners have taken an absolute beating since this downward move began, yet they're reporting historic Q3 earnings very soon. They're on pace to report historic Q4 earnings after that. Momentum and sentiment, they've taken quite a hit, and rightfully so, based on this carnage. But what are investors missing right now, and what do you expect for the miners over the next 3 to 6+ months?
Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5, 6 months ago? No, actually back about in June, okay? It was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40 something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled I doubled plus in a matter of handful of months, and I can't have a sharp pullback. Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, we didn't even get to it this week when we pulled back into the high 60s. That's down in the lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay.
Oliver says recent gold and silver pullbacks represent a necessary breather after an extended gain, not weakness. Since breaking above its long-held cap at $34, silver has risen 50%, a rare occurrence of 8 consecutive weeks of higher highs and higher lows. Gold also survived 9 weeks of higher lows before momentarily falling below its prior week's range. Oliver says such pauses are not trend reversals. They usually reset market momentum and clear speculative excess. He believes the current weakness is a tired cleansing period that prepares for the next sharp upward rise. Oliver also demonstrates an important technical advancement: outperformance of the S&P 500 by gold, not merely a chart pattern. Money flows in the global financial system are changing. U.S. equities have absorbed most capital for over a decade due to zero-rate policies and constant liquidity support. Oliver believes this ratio is close to a breakthrough because gold outperformed the S&P by over 60% and is pressing against a multi-point resistance line. If confirmed, it would signal a structural shift from stocks to precious metals, an uncommon event in modern markets.
You made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. What I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down. on momentum. And you got into what we call an oversold situation with only that one bad week, creating an oversold situation. Whenever we've seen that occur over the last year, there were like 3 or 4 instances of where similar action occurred. That was it. It was over. I don't care how bad that week looked. You didn't follow through in a sustained way after that. You started the turn. So even though it looked ugly, especially to price chart watchers, momentum says, no, you're through. You're exhausted on the downside. And I think that's where we are. And that's the nature of the sell-off you're going to be seeing in the future. It's not this 1 year wide range that silver had between May of last year and June of this year, where you could just draw a line through about $32 and it'd be above or below it for a whole year. Or gold, like 5 months, April through May, June, July, August, sideways recently. That's not going to happen anymore. We're now in an accelerated phase. And in particular, when this particular spread chart breaks out, it not only says is gold going to beat the S&P, but it means the money flow is really just beginning out of stocks into gold, which means what? The verticality we've seen in price lately in gold is just the beginning of that sort of verticality. The spread that we're watching, we think, is enormously important. This only goes back to 2020. If you recall, in early that year, silver about doubled in price, went from like $15 to 30 in 6 months. A lot more than gold went up. So this spread went from 0.9% to 1.5%, which is, huge move. Silver doubled, gold went up like 40% or so during that surge. And then what happened after 2020, price-wise, late 2020, silver had bumped 30 area, and it went sideways to down while gold went sideways. Okay, so on a relative basis, silver, that black line there, the black zigzag, is the price of silver divided into a price of gold, ounce per ounce. And silver went from 1.5% of the price of gold down toward 1% of the price of gold. So it's been an underperformer for all those years, though it's been going up in price, admittedly. Now, in the last handful of months, you can see that spread has shot up again, the top chart now. And there's a black line, a downtrend that we bumped. And this month, we're backing off from it. So we've got a 3-point trend line there to focus on going forward. But we also have the green line. What does that say? That's a level where since 2022, silver has hit 1.31% of gold, 1.31% of gold. It's set a dual top there. If you go through that, it's called a triple top breakout. And we think that's about to happen. When we run, and now I'll tell you why this is important in a minute. When we run the momentum of that spread, which is the chart at the bottom, where we measure the spread in relation to its 10-month average, you have similar looking picture, except that the momentum is already broken out over its downtrend line, and it's bumping the horizontal structure, whereas the spread is not. In other words, momentum is ahead of the spread. It's closer to a full breakout than the spread is. If that momentum breaks out, and it doesn't take much to do it between now and Friday, for example, end of the month, you can bet the spread's going to break out. Now, why is this important? One, silver's cheaply priced to gold historically. You go back 50 years.
Oliver's technical certainty in this breakthrough comes from structural clarity. He says momentum or spread structures rarely fail when they hit you in the face. This setup is evident in the silver to gold spread, gold to S&P ratio, and minor charts. Momentum precedes price movement, and all indicators point to a continued rise. Even mining stock sell-offs, despite record Q3 earnings and expected historic Q4 performance, match the pattern of temporary dislocation within a bull trend. For instance, GDX has increased in months but is still below its historical highs. Such corrections are normal in Oliver's thin air bull market, when price gains outpace emotion but structural trend maintains. Investors often overlook momentum patterns outside chart dynamics. They reflect macro factors, global fiscal expansion, rising energy prices, and geopolitical concerns are changing hard asset narratives. Central bank gold buildup, electricity shortages, and social unrest in key industrial districts all contribute to a cycle where tangible value outperforms paper assets. Oliver's predictions suggest this process is only beginning. He says the whoosh impact is technical validation and a psychological tipping point when retail capital realizes what institutional flows predicted. This structure resembles the 1970s, early 2000s, and 1930s bull cycles through the miner's proxy performance. Each started with skepticism, grew through volatility, and generated multi-year exponential gains. Gold's breakthrough over long-term relative resistance and silver's imminent triple-top breakout suggest a multi-year phase of accelerated money flow from inflated financial assets into cheap hard assets. Oliver's algorithms suggest the latest pullbacks are not the conclusion of a rally. They're the start of a bigger shift. The precious metals positioning window may be closing as momentum and relative strength shift. Long-term investors and those watching for the next major macro cycle must understand what's happening beneath market noise. If you found this analysis useful, like this video, share it with other metals investors, and subscribe for our next phase coverage of gold, silver, and miners. Thanks for watching.